Welcome to the Capital News. I am your host, Alex Karitis. Today is September 23rd, 2019. Thank you so much for joining me. I hope you all enjoyed your weekend. I know I didn't do a podcast yesterday evening for just the week look-ahead segment because, surprisingly, a lot of things didn't take place over this weekend. And we did, I think, a pretty good job on Friday discussing what to be on the lookout for as we make our way into this week with the UN General Assembly, with the continuation of the unknowns surrounding the Iranian situation, the Saudi Arabia situation, the trade situation, the repo market with the Federal Reserve, a whole host of things that we said were just going to remain unresolved, and we're just going to have to wait and see what transpires. Now, obviously, we were hoping that it was an uneventful weekend, and thank goodness it was, because typically if it would have been eventful, it probably would not have been good news. So no news is good news in this sense, so we'll take it. So that's why I shied away from doing a podcast yesterday. Now, we're going to continue with our discussion on some of those things that we were talking about last week, because they are still front and center. I'm pretty much today going to focus on the continuation of the global slowdown, because we are starting to see, once again, a rollout of more PMI numbers, Purchasing Manager Index numbers, from the world over, and the story ain't pretty, folks. Now, this is no surprise to us because we've been focused on this. These are, in my opinion, important pieces of the economic puzzle that we have to put together. These tend to be leading economic indicators, telling us what's likely to happen in the future, because these are surveys of what's going on in the business. So we have projections. Is there an increase in backlogs? Is there an increase in hiring or an increase in layoffs? What's coming down the pike? Are there new orders? Are they picking up pace? Are they slowing down? Is it expansion? Is it contraction? This is what we look for. We got to put everything together, because if you just read the headlines, and it depends where you go, but if you just read the headlines, sometimes you say, well, the number beat expectations, so everybody thinks that it's a great number. Sometimes it might be, other times not so much the case. And that's why you have to look past the headlines. And when you have these fancy algorithms scouring the internet for headlines to see how to trade, to scalp a few bucks here or there, that's what they look for. And if it looks and sounds positive, that's how they're going to trade. But if you actually read the report, there might be some things beneath the surface that says, we got to take a deep breath here and say, well, it does look like things are continuing to slow down. And when we look the world over, that's exactly what it's pointing to. And we just have to be prepared for it. This is the part of the cycle. This is the business cycle. We are reaching the apex. We are reaching the tip of this expansion. And that's okay. That's okay. You have to understand that recessions are the correction, and it's called a correction for a reason. You write a paper, you turn it into your teacher, she marks it up with a bunch of red ink. You didn't fail. She's helping you correct it. So when you turn in the final paper, it's a better project, it's a better paper. You got better ideas, you got better sentences structured. It makes sense. Now, of course, nobody wants to see all that red ink. Nobody wants to go through the pain that comes along with a recession, and it could be mild. I've never ruled out that it could be mild. Of course, it's a possibility. I just don't see it as being a probability. I think this is going to be quite bad. Very bad. Very, very bad. But I could be wrong. But time will tell sooner or later. But there is a correction to all of this madness, to all of this money printing, to all of this debt creation at the household level, the consumer level, the government level, the corporate level, at the central bank level. It has to be called in. It's too much. It's too much. We have trillion-dollar deficits, once again, and what do we have to show for it? A continuation of a crumbling infrastructure, a continuation of endless wars, a continuation of continuing, perhaps getting involved with other endless wars, not good, a continuation with trade wars with China, and if and when that ever gets resolved, and that's a big if, are we going to move on to the European Union? Because we've heard multiple times from Donald Trump specifically, but even some others within his administration, because I'm sure that's where he's picking up this note from, is he says, well, yeah, China's bad, but guess what? The European Union's even worse. Well, how can he not then go after the European Union next, if and when he gets a deal with China? And we're going to talk about that a little bit more, too, because there's some conflicting stories, no surprise there, on what's going on with those talks. But first, briefly, to the United Nations General Assembly. I'm sure some of you are aware of this young teenager, what's her name, Greta Thunberg or something like that, over there from the Netherlands, I believe it is, and she sailed over here, took a boat across the Atlantic a couple weeks ago. She's 15 or 16 years old, something like that. She's big with the climate change, and it's a mass extinction level, and she gave an impassioned speech before the General Assembly or some people that were at the United Nations, whatever. And, good for her, I guess. Why did she have to take a boat over? Wouldn't it have been quicker to fly? I don't know all the details. I don't pay too close attention to this. I don't know if it was a sailboat or if she had an engine. Was she polluting the ocean? Why couldn't she take a plane? Wouldn't it just have been quicker? Hey, I'm here. Now I got to give my speech and do my thing. I mean, look at it this way. I mean, 100 years ago, she might have hit an iceberg. She might have pulled a Titanic. I mean, so is she complaining that it's warming or what? Because she might not have made it 100 years ago. I'm just saying. I mean, what is she trying to prove here? Marco Polo did this a long time ago. He went all the way around. So I just don't get. I get you're trying to make a statement. You're 15, 16 years old. Okay, good for you. But, I mean, what is the world coming to where we have to listen to 15 or 16-year-olds? How many bills does she pay? How many degrees does she have? Now, it doesn't mean that she's, she's not intelligent. I'm sure she is. I'm sure she's well-read on some of these things. But why does it take a 15 or 16-year-old to get people's attention? I mean, it's a serious question. I mean, are you going to go to a 15 or 16-year-old neurosurgeon or a cardiologist if you got a problem? You're going to go to a 15 or 16-year-old accountant at tax time? I highly doubt it. So this is just, good for her. She wants to sail across the Atlantic, and her parents, I guess, said, yeah, go ahead, honey, you do what you got to do. But just a little outrageous in my opinion. But there was some humor in this, at least I thought it was, and some of you may have seen this on Twitter, and this might have been on some of the television programs too. I wasn't watching much TV today, but I did see it on my Twitter feed a couple times. People posting Donald Trump at the UN walking down a corridor. I believe he was with Mike Pompeo, the U.S. ambassador to the UN, and Vice President Mike Pence, and a couple other people in the entourage. And they're walking down a corridor in the UN, and in the back against the wall, along the wall, is this young lady, Greta Thunberg, if I remember her last name, and she sort of gives this quick, excited look on her face because she obviously knows somebody big is walking through. And then as soon as she notices that it's President Donald Trump, she just gives him the nastiest evil eye you've ever seen. It's just hilarious, like boom, drop of a hat. She went from, curiosity, who's coming through. It's Donald Trump, wanted nothing to do with him. Now, I have no idea if the president saw her and was aware of her presence in the room, but quintessential Donald Trump, he did not care one way or the other, just continued to walk through, just saying, thank you very much to everybody in the media, just, grandstanding, doing what he does. It was pretty funny. If you can find it, you can most definitely find it on Twitter, but I'm sure they talked about it maybe on Fox, CNN, MSNBC. Somebody's going to have it because it was pretty comical. So we'll see what happens there. We'll see if there's any big change in regards to climate policy. And Donald Trump, surprisingly, he did show up to the UN Climate Summit. He was not supposed to go. He was not expected to show up, but he did. He was focusing more on religious persecution. He was taking part in those meetings, but he did show up with the UN Climate Summit, and basically his answer was like, look, I'm for clean water and clean air. I mean, is he trolling the media? But I mean, who isn't for clean water and clean air? I mean, it's everybody's. So, I mean, everybody just wants to get hyperbolic. If you're not for solar panels every 10 feet or wind turbines every 100 yards, look, there's solutions to these problems. We're making great progress. This isn't the drop of a hat, the flip of a switch. It's going to take time, but we are most definitely moving in that direction. We are moving away from coal. We are moving towards natural gas. We are moving towards solar energy and wind turbines, and perhaps maybe more nuclear. I don't know if that's going to happen or not. The word scares a lot of people. If they maybe called it something else, if you had a nice PR team come in there, it might turn it around a little bit, because you have to understand that nuclear power in this country is the base load. I mean, that's the big granddaddy of it all. Most people don't understand this. That's the base load. When you have higher demand for energy, it's when they start turning it on. They turn those other turbines on with the natural gas power plants and coal power plants and those types of things. But base level here in the United States, it's nuclear. And most people don't understand that, but a lot of people just don't recognize that nuclear is actually a very safe and clean energy source. But the word nuclear just, gets the idea that it could be disastrous. And of course, there is the potential that it can be. You do have your meltdowns. You do have the Fukushima problem in Japan a handful of years ago. So it's warranted, but people get a little over the top, which tends to be the case. But that's that. Some of the market news before we get into some of these other PMI numbers that we're going to go through. We have the S&P down 29 cents today. The Dow Jones Industrial Average gained 15 points. The NASDAQ shed 5 points, and the Russell 2000 lost 1.5 points for the day. So clearly, relatively flat. The Dow Jones Transports lost another 0.7%, and the New York Stock Exchange continues to be flat, but still slightly, very slightly in the negative for the day. At the time of this podcast, oil remains pretty much at the same level it was on last Friday's podcast. WTI is at $58.40 a barrel. Brent, the international metric, is at $64.50 a barrel. Gold right now, at the time of this podcast, is trading at $1,522 an ounce, slightly below where it was in the day's trading session, where it was up over 1%. Silver is slightly down as well at the time of this podcast. It is at $18.57, but earlier in the day it was up 3.6%. So this is just a slight pullback as I'm reading this podcast late in the evening here. So again, quite the turnaround in the precious metals markets. Again, I continue with my belief and analysis that we are in the midst of a bull market run when it comes to the precious metals. That's platinum, it's palladium, it's gold, it's silver. All right. Some people have been saying we've been in one for quite a while, and that's okay. Obviously, everybody's entitled to their opinion and analysis. I sort of made this call, a couple months ago, and we've just been monitoring it ever since. We said anytime there was a pullback, that was to be viewed as an opportunity to get into those markets even more. Hopefully, you're stacking the yellow and white metals. And if you're not owning them outright, then get involved with their ETFs, GLD for gold, SLV for silver, or some of the mining stocks and ETFs that exist for both of them. That's another way to gain exposure to those markets, and they could quite possibly and probably outperform the actual price movements and percentage gains as opposed to the actual physical gold and silver. So that is to say the ETFs and the individual mining stocks might actually outperform the price performance and percentage gains of the price of gold and silver, respectively. And that's because those products, gold and silver, if they're on a takeoff, if they're in a bull market, those companies, all right, you have stocks that are traded based on their earnings power, based on their cash flow. If their core product has increased in value, but their cost structure has remained relatively unchanged because your fixed costs are your fixed costs, now you're starting to make a lot more money. You got stronger cash flows, you have stronger revenues, you have stronger profits. So that's what the market's looking for. And if you have, in this case, a stock market that's turning down or an economy that's rolling over and everybody is looking into safety, well, that's where they're going to go. So it could move at a greater pace than the actual physical price, but be diversified is what we always say here. So look at that, do your homework, conduct your own analysis, but precious metals, as far as I'm concerned, should be a part of a well-balanced portfolio. We have the U.S. 10-year Treasury down slightly, the yield that is, so catching a little bit of a bid with the price, another little flock to safety perhaps, and it is now yielding 1.71%. We have the VIX down almost 3% for the day and is now at $14.91. So we continue to monitor the bond market, which we do here on a daily basis, and it's because it is a lot bigger than the stock market, a lot bigger than the stock market, much more liquid. And we say, well, typically speaking, historically speaking, the bond market gets it right. We have the adults in the room that exist in the bond market. In the stock market, it's more of the frat boys. They just want the party to keep going, but eventually all parties come to an end, and you look for those signals within the bond market to say when the party might be ending. And we just saw, what was it, 2 Fridays ago, we had Is There Trouble in the Bond Market? Take another look at that podcast because we covered so much in there. Because what was the signal that we were seeing in the marketplace? Because a few weeks ago already, we had near record or all-time record lows on U.S. government yields. I mean, the 30-year was below 2%. Think about that for a second. The 30-year yield was below 2%. That tells you something, folks. That tells you that the market is anticipating a slowdown of massive proportion. A slowdown, theoretically speaking, that should take quite a long time, because if you're only going to get 2% on your money, and that's not net of taxes and inflation, you're not making anything. You're losing money. So who's going to park their money with Uncle Sam for 30 years just to get 2%? I mean, things must be pretty desperate out there if that's the best you can do. So it's not good at all. But what have we seen? And what was the focus of that podcast a couple Fridays ago? Is there trouble in the bond market? There was a big reversal, a big unwind. Even though markets were anticipating that the ECB, the BOJ, and the Federal Reserve were all going to cut rates or signal that they were going to cut rates or get involved with quantitative easing, that pushed those yields down. What happened? ECB comes out. Yep, we're cutting interest rates even deeper into negative territory. We're going to start on November 1st, 20 billion euros a month indefinitely. That's quantitative easing once again. Federal Reserve comes out the following week. Yep, we're going to cut interest rates by 25 basis points. Then you got all the shenanigans in the repo market, printing money overnight at the tune of $75 billion a night. That repo market is going to continue, folks. We talked about this last week, until at least the 10th of October. So we got a couple more weeks to go where this emergency line of credit to the financial system is going to remain open. And of course, we're never going to know who these institutions are because it's bank secrecy laws, and that's the whole purpose of it. They don't want to cause any panics. They can't get money from the big boys. Evidently, J.P. Morgan isn't giving this money out. Citi isn't giving this money out. Bank of America. The big boys aren't giving this money out on an overnight basis, despite the fact that they make a high proportion of their profits in overnight lending, and we talked about that last week. So something's amiss. Something underneath the surface is not kosher. It's not kosher. And this thing could unwind very quickly. We have officials from the Federal Reserve saying, no, everything's okay. We have everything under control. Remember the first time this happened? Oh, this is just a temporary thing, a couple days. This is just corporate taxes need to be paid. There were some U.S. government bonds that were coming due. Everything's okay. That's exactly what the Wizard of Oz says. Pay no attention to the man behind the curtain. Yeah, okay. What a charade. Those are the phrases that you look out for. When they say these things, that everything's fine, that it's contained, that it's just short term, that's when you say, wait a minute, something's wrong here. These people don't know what they're doing. They don't call recessions. They don't predict anything right. We're going to raise interest rates all last year and all this year. Now they're cutting them, and we might go to quantitative easing. How can you do such a 180 in such a short period of time when you have nothing but resources, nothing but PhD economists and financial engineers and anybody that you want to have a meeting with to come into the Federal Reserve and say what's going on? They still can't get it right. So something's amiss. When you hear those phrases, this time's different, it's contained, it's temporary, you know something's wrong. So we're going to continue to monitor that very, very closely. I said last week you got to put on your street smarts hat to understand who is affected by this, because those will be the institutions that go under. You're going to say, now it makes sense. Oh, that was the institution that must have been going to the Federal Reserve on an overnight basis. Now they're no longer in business. So that's what you're going to have to pay attention to, because they're not going to come out and say it's XYZ that's going under or it's in trouble. They're not going to do it. We have FedEx selling off again today, losing an additional 2% today, an additional 2%, continuing to put it below where it was in December of 2008. Quite telling. Although we have U.S. Steel gained back 2% for the day. So we were talking about that too last week. Another story I want to talk about here quickly, because I don't know if this is going to be a canary in the coal mine of other things to come, but there was a British firm over the weekend that went bankrupt. They had a file for bankruptcy. They are now going through liquidation, and that is Thomas Cook. Thomas Cook. I never heard of this firm. Perhaps many of you have. This firm has been around for 160, 170 years, something like that. The 1850s, I believe I saw. A travel agency, hospitality. They help people book their vacations and their holiday packages. And get this, because they filed for bankruptcy, all those people who were on vacation or who were on holiday, they're stranded. They're stranded. They can't get back because all of the deals were through Thomas Cook, and Thomas Cook is going out of business. So all of those people are stranded. Now, of course, they're going to be working with them to have some sort of solution to get them back to wherever they're from, probably, primarily within the UK. But nevertheless, not something those people were expecting. They're on holiday. Now they have to deal with these shenanigans. Could this be a canary in the coal mine? Because what's the reasoning they're going out of business? Too much debt. What a surprise. What a surprise. It's my understanding that a potential 9,000 employees within the UK could lose their jobs, which is not good anytime, but it's definitely not good now in the midst of Brexit, which hasn't gone anywhere. It's still up in the air. It's still up in the air. What's going to be the solution there? We have no idea. We have a quote-unquote hard deadline that's going to take place at the end of October on Halloween Day. Again, I use the quote-unquote hard deadline because I don't know if it's a hard deadline or not, because there was a hard deadline before at the end of March of this year. Did not happen. So I'm skeptical that they are actually going to leave. I hope they do leave, because that was the voice of the people in June of 2016. There's a prime minister in Boris Johnson who appears to be playing the strongman card, who's saying, look, we're leaving. One way or the other, we're out. And what's it, a couple weeks, we're going to have that big ceremony with the Queen. The Queen baby's going to put on a show. So we're going to pay attention to what she has to say. And it's the land of Shakespeare. This is what these people do. But she's going to be dressed up. She's going to have the crown jewels on. She'll be presenting something at the House of Lords. We'll keep you updated. Now to some of the global PMIs to wrap up this podcast, and just some other news that I'm making my way through. Again, I get a lot of this stuff from Trading Economics, tradingeconomics.com, a good website for some headline news and what's going on in the markets. So we have the stock market in South Korea hitting an 8-week high. Now, this is quite interesting because we said, well, we're going to pay attention here and there to the Kospi, which is the South Korean stock exchange, because it tends to be a leading economic indicator. It has obviously major trading partners around the world. It's a huge exporter. It trades well with Japan, although not right now. They're in a little bit of a spat, if you will. They're a good proxy to say what's going on in China, because the Chinese numbers are so up in the air, you don't know whether to believe them or not. I mean, typically you don't believe them, and so you look for other proxies to say what's the health of not only China, but some other countries, and in this case, South Korea. And it's now at an 8-week high. Now, of course, it sold off very aggressively over the past several weeks, and we said to be mindful of that because it was below where it was in December of 2018, and the economic data has not been getting any better. In fact, it's been getting worse, but we have this big rally in the South Korean stock market. Could this just simply be investors looking for yield and saying, well, they got beat up so much, now we're going to rally, we're just going to bid up the Kospi? Perhaps that's the case, because the other thing that we talk about here from time to time is also copper. Dr. Copper, the price of copper, because that too is a leading economic indicator. Is there a lot of copper sales? What's the price of copper doing? Because copper is an industrial metal. A lot of construction takes place. If there's a lot of construction, then that seems to fit well. Then there must be a lot of growth taking place. So we pay attention to those things. What's interesting right now is the South Korean market, stock market, and the price of copper. There's a big divergence. A big divergence. They are not trading in lockstep like they normally do. We have the price of the stock exchange for South Korea moving up aggressively over the past couple of weeks, and we have the price of copper remaining steady or continuing in a down trend. So who's right? Well, we're going to find out. So some other things as I make my way down the list. Thailand industrial output falls more than estimated. Another proxy for the health of Japan and for the global economy. Japan services PMI loses steam. Services PMI declined to 52.8 in September from a final reading of 53.3 in August. The headline grew at a softer pace despite stronger growth in new orders. In contrast, employment shrank and backlog accumulation slowed. On the price front, softer inflation was observed in output prices, whereas prices kept climbing for inputs. Not good. That's squeezing margins. Looking ahead, a weaker positive outlook was reported as firms prepare for higher taxes in the last months of 2019. Now remember, folks, A reading of 50 is break even, basically. A reading above 50 is expansion. Below 50 is contraction. Now, this number is still in expansion at 52.8, but excuse me, but it is slower than where it was last month and is a continuing trend here. And we got the margins being squeezed, and then you have taxes that are expected to increase at the end of this year. Now, I believe that's a value-added tax, a VAT tax, basically a consumption or sales tax being added on to the bill. Japanese politicians have put this off, I believe, for the last year, maybe 2 years, because the economy has been slowing down, and of course, higher taxes is never popular politically, but they've been kicking this can down the road, and now it appears at this juncture that this value-added tax is going to take effect later this year, which is not going to be good. We have the Japanese manufacturing sector shrinks again. Manufacturing PMI declined to a 7-month low of 48.9 in contraction in September from a final print of 49.3. New orders declined at a weaker pace, as new export orders were dragged by international trade dynamics, with both exports and imports falling at a double-digit pace in the prior month. Meanwhile, employment lost steam but continued to expand. On the price front, output costs continued to decline. In contrast, input costs rose again. Margins are getting squeezed. Not good at all. South Korean producer prices fall further. Making my way down the list. Paraguay cuts interest rates to 4%. Why not? Everybody and their mother's cutting interest rates. They might as well get on board too, and that's exactly what they're doing. Now, we have European shares were down today on the back of poor economic news coming out of Europe. Continues, folks. It just continues. Now, we have some U.S. data, and again, this is one of the things where you got to be wary of the headlines, because even on Trading Economics, and I think they do a pretty good job at calling balls and strikes, U.S. manufacturing growth accelerates in September. It's true. U.S. manufacturing PMI rose to 51 in September from a decade low of 50.3 in the previous month and above market expectations of 50.3. But if you look deeper into this report, not great. It's a little bit of a mixed bag. Employment was not great. New orders are not great. Back orders are not great. But it's sort of a little bit of a mixed bag. And of course, a little bit of a higher reading is better for the economy. I'm not rooting for this thing to go down, but this is a mixed bag. Don't just read the headlines. Go further into the report. Continuing, U.S. private sector activity beats forecast. The composite PMI rose to 51 in September from 50.7. So a continuation of expansion, which is a good thing. Although it is slowing down too if you go further into the report. We have U.S. services activity growth below forecasts. Now, this was sort of where everybody was sort of clinging to hope, right? Manufacturing, manufacturing's going down, but it's services that's going to save us. It's services here in the United States. U.S. services PMI went up to 50.9 in September from 50.7 in the previous month, but well below market expectations of 51.3. It was one of the lowest readings over the past 3.5 years, as new orders rose the least since the survey began in October of 2009. Not a good year, folks. Subdued demand resulted in a faster decline in volumes of unfinished work and a reduction in employment numbers for the first time in just under 10 years. A continuation that we are hitting the peak of this business expansion, which, look, this is the longest business expansion in the history of this country. This is what's going to take place. These things are going to start to roll over. We talk about this. We've given multiple presentations, video presentations on the capitalnews.com. I ask that you check those out and leave your comments. Those are also posted on our YouTube channel at the Capital News, where you can find that as well. We have the Eurozone services activity growth slows in September. This is why the major exchanges in Europe were down about a percentage across the board. Germany, France, Italy, Spain. Market Eurozone services PMI dropped to 52 in September from 53.5 in the previous month and below forecasts of 53.3. Eurozone manufacturing shrinks the most in 7 years. Manufacturing PMI slumped to 45.6, well into contraction in September of this year from 47 in the previous month, and well below market expectations of 47.3. The latest reading pointed to the steepest contraction in the manufacturing sector since October of 2012, as output fell the most since December of 2012. In addition, new orders declined at the fastest rate since July of 2012 due to further steep loss of export sales. In addition, sentiment about the year ahead in manufacturing was the lowest since 2012, contributing to a further culling of factory jobs, which were cut to an extent not seen since April of 2013. On the price front, input costs fell the most since April of 2016, leading to one of the largest falls in factory selling prices for 3.5 years. Now, 2012 is important for Europe because that's when you had the debt crisis. That's when you had the pigs nations. Everybody was like, oh, run for the hills. Pigs, remember? Portugal, Ireland, Italy, Greece, and Spain. Those were the periphery, with the exception of Italy. Italy's a massive economy. Those were the periphery, particularly Greece, and it brought Europe to its knees. Now, of course, they had a whole host of other issues, but it was the periphery nations that caused a huge problem. Now you got the big boys in trouble. You got the UK in trouble, you got Germany in big trouble, you got Italy in trouble, and you got France in trouble. Forget the periphery. And let me tell you something too, folks. Politically speaking, this is one of the main reasons I say I do not anticipate that the euro is going to exist in 10 years, or the European Union in its current shape and form is going to exist in 10 years. Because there's not going to be any sympathy or empathy from the Greeks for the Germans. Believe me when I tell you. The Greeks are not going to care that Germany is in recession. They're just going to say, too bad. You didn't help us out. You screwed us over. We don't care. Shame on you. This is what you get. Believe me, that's going to be the attitude of a lot of people. That's why you have populism on both the far left and the far right. There is no community. There is no sense of Europe. There just isn't. And when things get nasty, people are going to get siloed back in. The Greeks are going to stick with the Greeks, the Italians with the Italians, the Spanish with the Spanish, the Brits with the Brits. This is what's going to happen. Believe me when I tell you. It will not be a pretty picture. Continuing, Eurozone private sector nearly stalls in September. PMI fell to 50.4 in September from 51.9 in August and below market expectations of 51.9. And again, you have to go back to 2013 figures, 2015, 2016. You got to go back a few years to get back to these numbers. Now, the granddaddy of them all, obviously Germany. German private sector contracts for the first time since 2013. Germany composite PMI dropped to 49.1 in September from 51.7 in the previous month, and well below market consensus of 51.5. The reading pointed to the first contraction in the private sector since April of 2013 and the sharpest since October of 2012, as manufacturing output shrank to 41.4. 41.4. The lowest in over 10 years, and the services activity growth slowed to a 9-month low of 52.5. Job creation stalled after nearly 6 years of employment growth amid weakening demand and pessimism towards the outlook. On the price front, average charges increased at the softest pace since August of 2016 due to weaker price hikes in the service sector and a deepening decline in charges levied on goods. Overall input price inflation eased to a 41-month low. Lastly, expectations towards the outlook for output over the next 12 months remain negative, albeit rising slightly from August's 81-month low. So you didn't have a great benchmark. It was a very low hurdle, but they overtook it. So again, folks, if Thunder Thumbs Donny Boy wants to settle up with the Chinese, is he then going to go after the Europeans? They're already in contraction. Imagine what it'll do if we continue the trade war with Europe. Germany factory activity at a over 10-year low. Again, this is at 41.4, but just a little bit more input on this. 41.4 in September from 43.5 in the previous month, and missing, again, market expectations of 44. The latest reading pointed to the steepest contraction in factory activity since the global financial crisis in mid-2009, as output went down at the sharpest pace since July of 2012, and new business declined at the quickest pace in more than a decade amid lower foreign demand. And again, Germany is a proxy for China because the Germans export a lot of goods to the Chinese economy. Also, the job shedding rate accelerated to the fastest pace since January of 2010. Finally, sentiment remained around the weakest recorded since this series began in July of 2012, amid uncertainty and concerns about the economic outlook, namely in the automotive sector, trade wars, and Brexit. So, folks, we are not out of the woods. We are far from it. We're still in the early innings of this game, and we are just starting to now realize factually here with these numbers what we have been talking about here since this podcast has been out there since February of this year. And believe you me, I have been talking about this for a lot longer than that. Now it's just a matter of all of the numbers coming to fruition. Sometimes you wish you weren't right. But again, this is the correction. This is the business cycle, and it's a global business cycle. We are interconnected. That's why I'm saying the United States is not an island unto ourselves. We are going to be affected by this, and we already are. We already are, and we're going to continue to be as we make our way through this. So we covered a lot of news, a lot of headlines. Again, if you want further in-depth analysis on this, you could check out tradingeconomics.com to find a little bit more about these reports. And, of course, you can always go to Google and find those reports as well on all of these PMI numbers. But things are not looking good. But it's part of the process. It's part of the process. It's why I tell you all the time, stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.